AMC is running out of cash, buried in debt, and what happens next could wipe out retail holders. Will AMC collapse in 2026, or has it dodged the bullet? Stick around because we're breaking down AMC's real bankruptcy risk with hard numbers, not memes, so you know exactly what's coming. Let's start with the financial cliff AMC is staring down in 2026. Right now, AMC has about $5 billion in total debt. That's not just a big number on a balance sheet, it's a ticking clock. The company has debt maturities coming due over the next few years, and 2026 is when things get serious. They're holding around $300 million in cash, maybe a bit more depending on the quarter. But when you stack that against billions in obligations and ongoing cash burn, the math gets uncomfortable fast. Here's what makes 2026 the countdown year. AMC has significant portions of its debt structure expiring then. If they can't refinance or pay down those notes, default becomes a real possibility. And default doesn't always mean immediate bankruptcy, but it opens the door. Creditors can demand payment, seize assets, or force restructuring. For shareholders, that usually means getting wiped out or massively diluted. The key thing to understand is this: AMC doesn't have enough cash on hand to cover these maturities. They need to either make a lot more money, refinance the debt again, or keep tapping shareholders. Now, some of you might be thinking, didn't they already refinance? Yes, they did. In July 2025, AMC pulled off a major debt restructuring. They managed to reduce their total debt load and push out maturity dates. This wasn't magic. It was negotiation with creditors who realized getting something later was better than getting nothing now. The restructuring lowered the immediate pressure and gave AMC more breathing room. But here's the catch. They didn't eliminate the debt. They just moved it down the road. The company still owes billions, and the interest payments alone are crushing. Every dollar they pay in interest is a dollar not going to improving theaters or competing with streaming. So what did this refinancing actually buy them? Time. Maybe 2 or 3 years to figure out a path to profitability or to engineer another financial maneuver. But time only matters if you use it well. That brings us to the real question. Can AMC's operations actually support this debt load? Let's talk cash burn and whether theaters are making money. Post-pandemic, box office revenue has bounced back, but not to pre-2020 levels. Big blockbusters still draw crowds. Think Top Gun Maverick, Barbie, Oppenheimer. Those films saved AMC's bacon in 2022 and 2023, but the problem is consistency. For every Barbie, there are a dozen flops. The theatrical window is shrinking. Studios are sending movies to streaming faster. Consumers have more entertainment options at home than ever before. AMC's revenue is tied to factors they don't fully control. On top of that, operating costs are high. Real estate for large theater complexes, staffing, maintenance, utilities. AMC runs over 900 locations globally. That's a massive fixed cost base. Even when attendance dips, those costs don't disappear. The company has managed to eke out positive quarters here and there, but sustained profitability remains elusive. Free cash flow, the actual cash left over after covering expenses and capital expenditures, is often negative or barely positive. And remember, they need cash not just to survive day to day, but to pay down or refinance that mountain of debt. If you think AMC's debt is gone because of one restructuring, think again. The real danger is still lurking below the surface. Here's where it gets even messier: share dilution. AMC has leaned heavily on issuing new shares to raise cash. During the meme stock craze, they capitalized on sky-high stock prices to sell equity. It raised hundreds of millions of dollars, which helped them avoid immediate collapse. But every time they issue new shares, existing shareholders get diluted. Your slice of the pie gets smaller. The company might avoid bankruptcy in the short term, but if you're a retail holder, your investment gets watered down over and over again. It's a hidden tax, a slow bleed on shareholder value. And the worst part? They might have to do it again. If cash gets tight and refinancing becomes difficult, issuing more shares could be the only option left. So what are analysts saying about all this? The picture is split. On the bull side, some point to the successful refinancing as proof that AMC can manage its debt. They argue that as long as big movies keep coming and people keep going to theaters, AMC can limp along and eventually grow into its debt. There's also the retail army factor. AMC's stock has a loyal vocal base that's willing to buy and hold no matter what. That support can create opportunities to raise capital. On the bear side, the arguments are brutal and straightforward. The business model is broken. Streaming has fundamentally changed how people consume content. AMC's debt is too large relative to the cash it generates. Even with refinancing, the interest burden is unsustainable. Bears point out that every quarter of cash burn and every new share issuance brings the company closer to a point where creditors lose patience or shareholders lose faith. They also note that other theater chains have filed for bankruptcy in recent years. AMC is bigger, but that doesn't make it immune. If anything, it makes a potential collapse messier. So what must happen for AMC to survive 2026? Three things, really. First, they need box office trends to improve meaningfully and stay strong. Second, they need to achieve genuine operational profitability with positive free cash flow. That means cutting costs where possible. Third, they need to manage their debt carefully. That could mean another refinancing, finding a strategic partner, or negotiating more favorable terms. Here's the bottom line. AMC is not bankrupt yet. They've bought themselves time with refinancing and share issuances. But the clock is ticking, and 2026 is a critical year. For retail holders, the risk is real. Bankruptcy might not be inevitable, but it's absolutely on the table. And even if AMC survives, continued dilution could shred the value of your shares. This isn't financial advice, it's just the hard numbers and the reality of where AMC stands right now. If you want more data-driven breakdowns, hit subscribe. Thanks for watching.